Today, I want to talk about how the SEC is terrified of the AMC squeeze. The SEC has tried for a long time to ignore illegal synthetic shorts. They tried with Tesla, they tried again with GameStop, and they've tried again with AMC as well. But each time it just continues to get worse and worse for them, and even worse for the shorts involved. And it seems the SEC is now trying to even hide the FTD data to divert attention away from AMC. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, first, let's hear what Elon Musk had to say about the SEC's involvement on Tesla's synthetic shorts. As you can see from Investor Turf, it says Tesla's CEO Elon Musk spoke on the Lex Fridman podcast about how the SEC never pursued the hedge funds that were shorting and distorting Tesla, and he discusses the personal interests that explain why the SEC won't do it.
But not once did the SEC go after any of the hedge funds who were nonstop shorting and distorting Tesla. Not once. They would lie flat. The hedge funds would lie flat out on TV for their own gain at the expense of retail investors. Not once, literally 1,000 times. Not once did the SEC pursue them.
How do you explain this failure?
The incentive structure is messed up because the lawyers at the SEC are not paid well. It's a fairly low-paying job, but what they're looking for is a trophy from the SEC. They're looking for something they put on basically their LinkedIn.
Yeah.
From that, they can get a job at a high-paying law firm. That's exactly what the lawyer here did. And the reason they don't attack the hedge funds is because those hedge funds employ those law firms, and they know if they attack the hedge funds, they're affecting their future career prospects. So they sell small investors down the river for their own career. That's what actually happens. Regulatory capture.
Regulatory capture.
Yeah, not good.
So as you can see, Elon Musk is basically explaining here why employees at the SEC don't go after these hedge funds. Because when they're employed at the SEC, the salary isn't too great and they want to further their own career prospects. So therefore they ignore those hedge funds that are pretty much off limits for their own career intentions. And as I said, it now seems to be at the point where the SEC is now even trying to hide the FTD data, not just in AMC, but market-wide. As Stonks Batman tweeted, they said it's November 12th and FTD data for the first half of October is 12 days late. The second half of October is now due in 3 days. Saying we're now midway into November using September's old FTD data, saying this is not transparency in the markets. You can see from the FTD data, there has been no update to FTD since the end of September, and this website even says the first half of the month is available at the end of the month, and the second half of that month is also available around the 15th of the next month. So therefore we should have the entire of October's FTD data from tomorrow, but we don't even have the first half. It's so bad that a few days ago, Ortex even wrote to the SEC saying this month the FTD data that would normally have been published at the end of October is notable by its absence. For the sake of market transparency, can you please publish the missing data as soon as possible? I also wanted to quickly recap today's trade from the Millionaire Mindset Trading Group. It was again LIFW, which is a stock we also traded successfully last week. Last week, LIFW gave us 225% gains, and this morning was almost too easy with the exact same setup. As you could see, LIFW hit this similar pre-market high at $6.12 per share. At the market open, that pre-market high ended up breaking and it pushed higher, giving us that confirmation and that continuation. Later on in the morning, you could see that move was getting incredibly overextended, trading outside of the Bollinger Bands, giving us our exit. And if you guys want to make daily profits like 35% today, be sure to join the Millionaire Mindset Trading Group linked in the description below. So not only do the SEC ignore synthetic shorts, not only do they ignore hedge funds, not only do they ignore FTDs, they also ignore overseas hedge funds entirely. Crystal Ball tweeted saying the Cayman Islands have no rules on short selling and don't cooperate with foreign jurisdictions, allowing short sellers to hide. He said see below for some details. Some of these Cayman Island hedge funds have been uncovered before, and that's what's happening now with AMCs, because these overseas short sellers don't report their short positions. As you can see, as a prime example, Tiger Global used a shell company to short sell shares of Quindale, saying anonymous Cayman Island-based entities are behind large bets against 12 European companies. Obviously, we know these Cayman Island hedge funds don't just short sell European entities and European companies, they also short sell US stocks. And they're also not required to report those shorts, they're not required to report their FTDs, and all of this data goes hidden. And that's because the SEC, again, simply ignores those FTDs and those synthetic shorts. But interestingly, Alpha Spread is actually reporting something very interesting for AMC. Namely, AMC's intrinsic value is way higher than its current share price. They're suggesting AMC's share price is currently undervalued by about 78%, putting it in severe deep value territory. As I spoke about on Friday, this is what deep value investors like Michael Burry look for in a stock. They look for a stock that's very undervalued but has good potential because it's a profitable company, generating positive cash flow and more. So if you didn't know, intrinsic value is the measure of what an asset or a stock is worth. Financial analysis uses cash flow to determine the intrinsic or underlying value of a company or a stock. Basically saying that based on AMC's positive cash flow, because it's now cash flow generative, AMC is undervalued by about 78%, and the stock price should at least be, on a base case non-squeeze scenario, over $35 per share. As I said, this is obviously on a non-squeeze scenario, and if AMC runs to over $35, it could very easily trigger a short squeeze. Because as we know, when share prices push up higher, especially in heavily shorted names and in meme stocks like AMC and GameStop, it causes these short sellers to become more and more stressed. And when they're stressed, they have to start closing out of short positions until eventually all of their shorts are closed out of, real shorts and synthetic shorts. Because alternatively, if they don't close, the hedge fund will get messier and messier and will eventually face liquidation. Either that or the entire system would end up breaking. And that's why Charles Gasparino tweeted saying the world is falling apart because people invested money in that theatre chain and a lot of other meme stocks. Literally saying word for word, investing money into AMC and these other meme stocks is causing the world to fall apart, or is causing these hedge funds to end up being closer and closer to going bankrupt. Guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.